Welcome back. In our top business story, a Dubai Chamber of Commerce and Industry delegation visited a diamond trade exhibition held in the city of Surat in northern western India, known as the country's diamond hub. The official visit also helped the delegation to lay the groundwork for a Dubai Trade Mission's visit coming up later in the year. During the visit, officials discussed ways of strengthening trade ties, especially in the diamond and textile sectors, in line with the Dubai Chamber's efforts to support the development of businesses and to boost their competitiveness in new and productive global markets. Volumes on the Dubai Gold and Commodities Exchange rose more than double in 2011 from the previous year to over 4 million contracts. The total value of contracts was recorded at $185 billion, up 110%. That's the highest number of contracts registered ever since the DGCX started its operations in 2005. Since then, the exchange traded over 10 million contracts to a value of $476 billion. Currency trades witnessed the highest growth, making up 88% of contracts for 2011, up 177% from 2010, while precious metals made up 11%, with volumes reaching over 443,000 contracts. Silver futures led the segment, rising 40% from 2010. Emirates expanded its horizons by linking Dubai with Buenos Aires, Rio de Janeiro and Ho Chi Minh City to its global network. Thierry Antinori, Executive Vice President of Passenger Sales Worldwide, stated that the new South American link will not only boost trade ties with the UAE, but will also introduce new travelers to the Emirates route network. Additionally, Emirates announced its expansion into Southeast Asia with the addition of Ho Chi Minh City in Vietnam to its global network from the 4th of June onwards. This is set to become the airline's 124th destination. Over the next 2 months, the airline will launch a further 5 destinations: Dublin, Lusaka, Harare, Seattle and Dallas. And now let's look at the stock indices across the GCC. France plans to sell as much as 8 billion euros of debt today. It's the country's first test this year of investor appetite for its bonds as credit companies threaten to cut the nation's AAA rating. We have Bruce Powers, Head of Research at Trust Securities, here with us to discuss the issue. Hi, Bruce. Welcome.
Happy New Year.
Now, looking at those huge refinancing needs of European countries, do you think that this year sovereign debt sales will go smoothly?
Well, I'm not very optimistic. They're going to face many of the same problems they faced last year with higher borrowing costs, the threat of downgrades by the rating agencies, as well as possible actual downgrades. Standard & Poor's already put 15 countries under review in early December for a possible downgrade. Top countries like Italy, France, Germany, UK, they have about $1.3 trillion to refinance this year. I think when we could really start to see some problems is in the second half of the year when the economic slowdown, the effects of it become more apparent. Now, we're in the third year of the debt crisis right now, and some of the countries in Europe are starting to head, or seem to be starting to head towards a recession. France may already be in one. Its debt to GDP ratio is the highest of the top-rated countries at 85%, and it needs has the second largest amount of debt that has to be rolled over this year. Investors are watching very carefully now the interest rate spread between German bonds and the particular sovereign to get an idea of changes in risk perception.
Now tell me about your guess of which asset class will be the most profitable one this year. Is it bonds? Is it stocks? And which regions do you favor?
Well, I'm not really big on forecasts, but if I have to pick one, I'd pick stocks over bonds. I think we're going into an economic slowdown and a possible recession in Europe, so that may not be good for either. But bonds are clearly overvalued with interest rates at 50-year lows. So either interest rates stabilize and stay where they are right now, or they go higher. If they go higher, that means bonds go down. As far as stocks, a slowdown is going to hurt corporate earnings growth, but investors can help protect themselves by getting larger capitalization companies that have good dividends. I think that the other benefit to having stocks is that the central banks are probably going to almost assuredly continue to flood the market with liquidity, keep the financial system going, and that will also help prop up the stock markets.